do the withholding. Nobody is questioning Hutch whether he's paying tax or not, because he's the guy who sold the company. The money came to him. He's having all the money that Vodafone paid, but nobody is asking him. Everybody is asking Vodafone, why you didn't do withholding? The 20,000 crores on his head, yes, he did do withholding when he made payment to Hutch. But Hutch is the guy who got the money. Nobody is asking him. So the liability is on the payer. When you pay, you are supposed to withhold tax. So please ensure whenever you pay to any contractors, ensure that ask a question. The best thing to do is ask questions. You should know what questions to ask. Answers, there are many people to give you. If you don't ask questions, you miss the bus. So ask questions as to whether withholding is required or not. And if you get a response from anybody that withholding is there, you do it, not there, don't do it. I would say that's all. And the payer files the changes return. This is a process of deducting the tax, and then when you should remit, what are the forms to it, what are the procedures. So, yeah, I can go on. Okay. How does this is a slide that talks about how a tax assessment happens in this country. So, you will file a tax return by September or some date, and the tax return will be taken up for scrutiny by the income tax authorities. So, he has time of about 1 year, technically, to issue a notice from September 30th. And after that, he has time of 2 years to complete the assessment. So if you file a return, for example, for March 12, closing, accounts closing, you are supposed to file a return by September 12. If you file it by September 12, he can issue a notice to take up the case for scrutiny till September 13. And he has time till 2 years, March 14, till March 14 to close the assessment. So for a year completed from March 12, he has time till March 14 to close the assessment. So technically that's the time which he will take to close it. And after he closes, in case you are not happy with this assessment, he has made some additions, he has asked you to pay more taxes, you can go and appeal to the assessment order. He will pass assessment order. Within 30 days, you can find appeal to the Commissioner of Appeals. And Commissioner of Appeals has got no time limit to dispose the appeal. You can just keep it pending forever unless you go and push it. On a best case basis, you push it, you get an order from him in a year's time, assuming, and you are still not happy. You can file an appeal before the appellate tribunal. You have time limit of 60 days to file the appeal. And again, there is no time limit in the country to ensure that the appeal is disposed of in a quick manner. Again, there you have to go and push so that the appeal is taken up early and then it is disposed of. Assuming the tribunal passes an order and you are still not happy with that order, you can go to High Court. Within 120 days, you can file an appeal before the High Court. And again, in the High Court, there is no time limit prescribed in this country to ensure that the case is heard in a fast track manner. Assuming High Court passes an order in 1 hour time frame, you can file an appeal before the Supreme Court. So a return that you file in March 12, if there is an issue, the assessing officer will take 2 years to complete. The CAT appeal, the Commissioner appeals will take 2 years to pass an appeal order. Tribunal will take 2 years to pass the appeal order. Technically, in my experience, what I've seen, High Court takes about 4 to 5 years to pass the order, and Supreme Court takes about 6 to 8 years to pass the order. So, if any dispute is there in a March 12 return that you file, the earliest you will get the finality of it is 2 plus 2, 4, 4 plus 2, 6, 6 plus 4, 10, 10 plus 8, 18 years. That is the time frame with which in this country we are working. Vodafone was an exception. That also, the case was initiated in 2006 and we got a finality in 2012, which took almost 6 years, 1/3 of the normal fast track time, only because it had an amount involving 12 years in courts, which otherwise it shouldn't have happened. So, this is the, if you are getting into a fight with the revenue authorities, be prepared to fight for 18 years. If not, assess the value, see what is the cost effect benefit If you have to pay the taxes and get it behind your back, please do that. If the amount is small, or if you feel that there's a 50-50 chance of winning, take a legal opinion, take a call on that, just kill the issue. No point in fighting in the system unless you have a very favorable case which you think that you are not in case. If you don't have a good case, it's a 50-50 matter and the issue is both ways it's arguable. The cost of fighting will be equal to the cost of taxes that we will save end of the day. Unless it is like a wonderful situation where amount is very huge. So take a call, each case has to be taken a call separately. Okay, some points for attention. If you're making payment to any vendor where he doesn't have a PAN number, you have to deduct a higher rate of tax than the tax mentioned. Normally the tax rates mentioned are 5%, 10% in the Act. But if it doesn't have a PAN number, you have to deduct a higher rate of 20%. That's a penalty for not having a PAN number. So you should keep that in mind. When you're making payment to the vendor, if the payment is subject to tax withholding and if the vendor doesn't have a PAN number, straight away deduct 20%. Otherwise, you will be under problem. The next thing is, don't make any payment in cash exceeding 20,000 unless you are making a payment to a villager who doesn't have a bank account, if you can prove that, or to a government authority. To a government authority, you can pay it in cash. But other than that, any third-party transaction, don't do it in cash. You will have to pay tax. You will have to pay tax on that because the government will say, well, the problem is when you pay cash, if it isn't accounted, normally they will account it. There's a tax leakage. The government says, you have paid cash and accounting, that guy is not showing as income and paying tax. You pay me the tax because I don't know to whom you pay. That guy is not traceable at all. Neither he has a PAN number. So don't make any payment exceeding 20,000 in cash. And any payment made to overseas persons, doubly check whether tax withholding is required, especially when you are buying softwares and making payment to overseas customers. There is a withholding tax applicable on that because there are a lot of rulings today which has come which says that payment for software is subject to tax withholding. So when you are buying softwares from abroad and you are making payment for it, as a corporate, you are supposed to do withholding and remit the balance of 10% minimum. If it doesn't have a PAN number, 20% minimum.
If we are buying software.
So as a corporate, if you're buying software from say Microsoft, you're buying a Microsoft Windows. So you have to make payment of $50,000 to him. You are supposed to withhold tax of 10% if he gives you the PAN number. If he does not give the PAN number, you are supposed to get 30% and remit the balance. If you don't do, the liability is on your head. So when you're making payment abroad, especially for software, be cautious on that. Okay, there is one more provision which says that we are all into research now. The country promotes research and development. So if you are putting up an R&D center, research and development center, which is approved by the DSIR, which has approved the smart city, so that enjoys a tax benefit. Whatever expenditure you will incur for that, if you incur 100, you get an equal amount 100 as a tax benefit. So if you can structure your business or structure your innovation thought process in a like an R&D facility, or there's a real research you guys are doing, and codify it in the form of a research center, get it approved from DSIR, Department of Science and Research, and get it notified to the income tax authorities. Then if you are spending $100, you get $100 as a tax benefit. So that you should ensure that if there's opportunity, use it. Other one is wealth tax. So many people will acquire land to put up their facilities and may not use it. If you don't use it for more than 2 years, you are subject to pay wealth tax on it. If the value of the land exceeds 30 lakhs. So 1% of the land value has to be paid as wealth tax. Similarly, if you have cars exceeding 30 lakh value, cumulatively put together, cumulatively, not individual car. If you have 5 cars, each car is 5 lakh rupees or 10 lakh rupees, 50 lakh rupees, exceeding 30 lakhs, you have to pay 1% as the wealth tax. Okay, some special schemes which may be of interest to you, because given that you are in the IT space, there are 2 schemes today run by the government. One is the STPI scheme. Software Technology Park scheme. It's a special economic zone scheme, which you must be broadly aware of. The STPA scheme was running till last year, and it has died with natural death. In the sense, the scheme is still valid, but you don't get income tax benefit on that. So if you, in an STPA scheme, any building can be, any space, even this room can be an STPA approved room, wherein you can import materials without customs duty. You can, whatever service tax, input service tax that you incur, you can apply for a refund. But the only thing is you will not get an income tax benefit, that benefit is over. So, yeah.
Import duty.
No import duty, no service tax. Service tax, you have to input service tax, you have to incur, but you can apply for a refund. On purchase of domestic goods, no customs duty. I think in some, you can also get refund of CST also. So if you pay central sales tax, that also you can apply for a refund and get it. In an STPA, the flexibility is you can bond any facility in the anywhere, even in the house, second floor you can say it's STPA. You can go and get an approval from them and then say that it's STPA bonded facility. Only thing is it has to be secured. There should be no leakage because you are keeping assets in that facility without payment of customs duty. So customs authorities will come and inspect time and again whether you are using the asset for the purpose you imported. You import it for your IT business. Are you using it for that business? Or your assets are used by somebody else for some other purpose. They will come and inspect. So it should be a bonded facility. You can have it anywhere. So you will have customs benefit, excise benefit, CST benefit, and service tax benefit. And you can the flexibility of bonding anywhere. No income tax benefit. The other scheme parallelly running is the SEC scheme. So here you can't bond any facility. You have to go to the SEC zone, which provides these spaces. Like we have Cochin SEC, we have Info Park SEC. So you have to go to that facility, hire a space, and then put up your business there. So in that case, today you will get the same benefit as you are getting in the STPI. No customs, no excise, no VAT, no service tax, and you get an income tax benefit also.
Company over here doesn't get SEZ.
Huh?
Company in this part.
You will have to go to SEC.
This is not SEZ.
This is not SEC. No? This is not SEC.
So
But you can bond this as STPI.
STPI.
If you want, you can bond this as STPI. But if you want SEZ, you will have to go to the SEZ facility and then hire space there. So if you do that, for 15 years, you will have an income tax benefit. First 5 years, no tax, 100% benefit. Next 5 years, 50% of the profits is not taxable. The last 5 years, the amount you transfer to a reserve. So what they say is, apart from income tax benefit, you should also allocate something for your growth. So last 5 years, what they're saying, the amount out of the profits you set aside for future growth in your books, to that extent, I'll give you benefit. So in addition, the only constraint between STPA and SEZ is STPA you can do it anywhere. SEZ you have to go to the facility. The benefit of going there is you will get income tax benefit additional. That is the only thing. Yeah, coming to indirect tax, they put it very briefly. Again, indirect tax, if you see, there are central tax like central sales tax, service tax, customs duty, excise. These are all central taxes. State level taxes, Kerala level taxes is VAT and octroi. In Kerala, they have octroi? Okay, so VAT and octroi. I'm not a specialist in indirect tax, I'm a specialist in direct and international tax. That's why I'm checking with my guys, no mistake. So in Kerala, we have both VAT and octroi. Okay, for VAT registration to be obtained, if your turnover crosses 5 lakhs in a year, you have to get a VAT registration. There's no VAT levy. Up to 10 lakhs, no VAT levy is there. You don't have to charge VAT. But if your turnover crosses 5 lakhs, you have to get yourself registered. And you have to obtain a tax, like you got a PAN, TAN, that's a TIN. You have to obtain a TIN. And when your turnover crosses 10 lakhs, your VAT charging triggers. So when you raise invoice from the customer, if your service is subject to VAT, you should charge it. Typically, you will be raising royalties and implementation services that may be subject to only service tax. If a VAT is applicable, a VAT needs to be charged, and you need to collect from the customer and remit it to the government. So this is the general overview on that. Yeah, service tax, as I was saying, they have changed service tax law from this budget from a positive list to a negative list. Earlier they mentioned some 119 items which are subject to service tax, and there was a black hole as to what is not subject to service tax. So people will try to get into the black hole saying that my service is not subject to service tax. The department will try to put them into this, one of the categories of 118 cases to say that you are liable to service tax. There was a huge litigation. Now what they have done, they have changed the clock. They have said that every service is subject to service tax except these 19 services which are not subject to service tax. So there is no dispute now. Everybody is subject to service tax unless you fall in 19 categories, which is very limited, very limited and very clear. So typically all your services will fall within the service tax except the export invoices that you raise, where service tax is not applicable on that. And for incubation facilities, there is a specific exemption given that up to 50 lakhs of invoices that you raise, service tax is not applicable for a period of 3 years. And in any year you cross the 50 lakhs, you will be subject to service tax from that year onwards. So apart from that, there is nothing great in this. And okay, whatever input service tax, when you say input service tax, you are also purchasing services, right? As a company, you will pay a telephone bill, there is a service tax in that. You will pay to a cab guy, he will charge a service tax in that. Those are all input service tax. That you can offset against your output service tax. So when you raise invoices, you have to charge service tax 12%. So if you raise a 100 rupees invoice, you have to charge 12 rupees as service tax. If your input, you are paying service tax to telephone company, lease line company, car hire company, say 5 rupees, you can adjust that to 5 and you pay to the government only the balance 7. So that is the input credit that is there. So that it's not double income, because what you are getting, you are invoicing. Your cost of developing a particular software includes this telephone line, this cab hire, this payment to security guard, you will be charging service tax. And then you total up your cost. Say my cost of developing the software is programmer salary, telephone bill, security, etc. My cost is so much $1,000. I'm going to invoice him, say $5,000. So when you are paying service tax on the $5,000, then it becomes double. So government is a credit of input that you pay. So that's the mechanism of it. Yeah, I'm done. So any questions I can take, or I can leave my card and visit and write to me. My email ID is not there. You can maybe want to type in maybe that I can note it down. Or my contacts are there with.
So excuse me for getting late, but can you please refresh that foreign direct investment?
Yeah.
I was not able to.
Go to the FDI. Yeah. So the regulatory framework in India is when a foreign investor is coming into India, there are 4 regulations which control inflow of foreign money into India. The FIBB, the RBI, the ROC and SEBI. The FIBB is the Foreign Investment Promotion Board. It regulates whenever a foreign company or a foreign investor wants to invest in India, it regulates as to which all sectors it can come. It is not, for many sectors it is automatic, for some sectors it is under approval, for some sectors it is no. They are not allowed in print, they are not allowed in atomic energy, they are not allowed in retail trading. But your case of IT services comes in the automatic route. There are no restrictions for foreign investment coming into your line of business. You don't have to apply for an approval. Only thing is when an investment comes, you need to.
How we can account those money?
The RBI is the next authority which says that when somebody invests into India, he has to invest at the appropriate value. If your shares are worth 1,000 rupees, he has to invest 1,000 or more. You cannot invest less. So when you receive that money, just go to the slide on equity and other things. Equity.
That means the foreign investment cannot come as an unsecured investment.
It can come. That's what this slide covers. So this slide covers a foreign investment can come as equity. First, that's the easiest form of getting foreign investment. But when you get it as equity, what happens? You dilute your stake. You have formed the company with 10,000 shares. You are the full owner of the company. You are asked somebody else to come and put equity of say 2 lakh rupees. You will have to allot him 20,000 shares. So he becomes 2/3 owner of the company suddenly. Do you want that? So that's a choice. That's a choice you have to make. You may say,
That's where the premium shares are also.
that is where next comes the preference shares. Where in preference shares, they don't own the company, but they get into the company for the purpose of sharing the profits as and when it arises. So they will come with a fixed coupon rate, like 10% preference shares. So you have to pay them 10% dividend. If you earn profit, you pay them 10%. They have preferential right over the dividend. Then only you can share the dividend. So you take them as preference shares. Or alternatively, take them as a debentures, wherein you issue notes, bonds, saying that you invest in my bond and this is the interest I'll pay you. And it can be two ways, non-convertible or convertible. Non-convertible, generally the coupon rate is higher, the interest rate is higher, because what is the fun in he investing at a lower cost to you? At least in the convertible, you will get shares at a later date. So you will convert, there's an option to convert these debentures into shares after say 5 years, 10 years, whatever terms you agree with him. You can convert these debentures into shares and give him shares at that point in time if you want to share your booty with him. So you can get the debentures at a low cost today, run your business, develop your business, and at the end of the 5th year, you can give an option for him to convert, or you can give an option to take the money back also. And the third one is taking external commercial borrowing, fourth one, wherein this is neither a debt, this is a full debt. There's no equity contribution. It is different from preference shares, equity, and debentures, wherein you borrow a debt from abroad because abroad the debt is cheap, unlike in India, which is 3 times the rate abroad. So you borrow the debt, but it comes with certain conditions. The RBI allows ECBs only for capital purposes and not for revenue purposes. When I say revenue purposes, not for running a business. Day-to-day running is not allowed.
Like buying an equipment will become
Only for buying equipments, putting up a facility, all that, capital equipment. For paying salary, paying to your security guys, all that is not allowed. So there's a restriction. Otherwise, you should take a local debt with a high cost. So the options are you go for an equity if you want to share your platform with others, or go for preference shares if you want to share your profits only with others, not your ownership. Go for debentures if you want a low cost debt so that you reward him later in the form of equity. This can be even convertible preference shares also. Need not be your equity shares. You have many options in debentures. Non-convertible debentures, convertible preference shares debentures, convertible equity shares debentures, partly convertible debentures, fully convertible debentures. Partly means you really convert a portion of the debentures. So various options are there in debentures. Debentures is the best form of convincing a guy to invest in you, showing a returns at a later date. Then the full equity is either local debt or a foreign debt. Local debt you can buy at a high cost, use it for any purpose you want. Foreign debt you can take it only for the capital purposes.
foreign debt should come from a bank only.
Not necessarily.
Individual person.
Individuals, not individuals, corporates. Individuals will be NRI investment. So NRIs can't give ECBs. So NRIs will have to invest in the form of preference shares or debentures or equity.
So the mode of their investment can be the NI accounts.
Yes.
Okay, so this is a serious question. Suppose the black money is there in India. Okay, and I'm putting it into an NI account and showing it.
How do you put it in NRI?
We can deposit the money in an NI account.
Cash.
Yeah.
Okay. But you have to pay tax for that, no?
Okay, sir.
When you are putting the cash into a bank,
One time if you are putting it, suppose we are dividing into small amounts and then putting it.
you can do all that. Problem is, it can be tracked. Where is India's system? It can be tracked. How much you will do? I mean, up to 50,000 only you can deposit cash. Beyond that, you have to give a PAN number. Once you give a PAN number, you are taxed. In the bank, if you have to go and deposit, only up to 50,000 they will accept. Beyond 50,000, you have to give a PAN number, address, name, telephone number, your father's name.
Okay, suppose it is done, sir. Suppose the black money is
Bank
getting
doesn't input. If the transaction is more than 10 lakhs, they will input
I
that.
know, but that is one time. I'm telling you
No, even for for the entire.
It can be tracked.
It's a transaction.
See, what will happen?
CD code.
Assume you find 100 people with 100 bank accounts in different banks. Everybody deposits 50,000 in their account, each of them, and everybody transfers 50,000 to your account. It's flexible. People will say, how did you get suddenly 10 lakhs, 50,000 each from 100 people? Then they will say, where all it went. Everybody will be 50,000 deposited in cash.
Bank authorities will request for the ban, then they will go.
We don't advise on converting bank money to white money.
No, just a question. There's no such activity.
So,
That's
That's a very grey area.
question was actually that whether it could be treated as a, like, we have to provide the money in our account, and then that money is coming again as a white investment.
all that is doable, but there are consequences for everything.
I got this.
Everything is a consequence. If you have a brave heart, stand over it. Yeah.
Just give my email, so any further queries or trigger address to.
And I think you can note it down, or, yeah. Make that larger. Make it larger.
That's all.
Anyway, the contacts are there in the office. So you can take it from there.
Srijit A. Impending.
See, I have a question, like, see, if I'm starting something today, and see, I need some pushing time, like, I need to find the market, I need to generate revenue, maybe that takes some time. So what is the right time, to go for kind of, addressing all this, all these forms?
See, companies that are not going to take a long time for you. It takes a lot, 6 weeks, 4 to 6 weeks maximum to set up a company. So what I would suggest is first you block your name. That's the first activity everybody should do, given that you have uniqueness in your product, which you don't have others to take. And you can, if you think that a company is required, because once you start the company, compliance starts kicking in. You have to file reports with ROC, with income tax, with all these guys. So you started closer to that. When you feel that the funding guys are also there, and then they also want to stake, they want to have a corporate kind of setup, set it closer to that. Because many times what happens, people set up companies and it is lying dormant. Compliance is not done. After 3 years, if you want to go and revive the company, you can revive it. But there's a cost involved in compliance because you may not have filed a return with ROC. If you go and file it now, there's a penalty. There are penalties for each day delay also. So there are certain penalties which says for every day 100 rupees penalty. For 3 years, it is 1,000 days. So you have to pay another 1 lakh additionally to them. So I would suggest that if you are have a venture and you are closer to getting into business with it, there will be time to set it up. Until then, block your name and keep it so that half the hurdle is crossed. Many times what happens when you go for a name, the RBI doesn't give it. They will say somebody has blocked it. The name has got the word India in it. The name has got the word corporation in it. So when you use the word India, corporation and all that, it gives a large presence. So the RBI also wants the capital to be large. They will say if you use the word India or corporation, the capital should be 25 lakhs. Will you provide it? Will you not be able to provide it? So one thing to do is you just go for a simple name with your unique product name in that, so that you block your product name with the company name. And then when you are getting an investor and the investor wants to have a larger percent, at that time if you are able to provide that higher equity, then you go for a change in name. You can change the name. Say today if you register, say Inox India, Inox Private Limited is this simple name that they will give it. Of course Inox is the caterer's name, I'm just using it. And if you want to add that Inox India Private Limited or Inox Corporation India Private Limited, So those gives, when you say corporation corp, India, I mean INOX corp, it gives a larger name to the global world. So to use that name, the ROC